Welcome to the Property Investing Roadmap podcast.
I would say once the thought is in your head, we would like to invest in some property, have the conversation.
Make time and discipline your friend.
I'm your host, Damian Collins, here to help you navigate the twists and turns of property investing.
The true investors are the ones that ask the right questions but then make a very quick decision, and they're the truly wealthy ones.
For real success, you need a real strategy.
Buckle up as we hit the road with expert tips, real life stories, and the 9 key steps to help you plan, build and optimise your property portfolio.
No one's going to invest to make a loss. You're going to make profit.
Great to be here again. In this podcast today, we're going to do something a little bit different. Switch gears. We're going to get out of residential property and we're going to talk about commercial property investments, and particularly how you can access some really great commercial property investments without necessarily having to invest millions of dollars. And we'll talk about how you can do that through funds. And look, my philosophy, as people who know, who've read the book and are listening to this podcast, residential is a great place to start. When you're investing in property, you want to start in residential, but it's not necessarily where you want to end. The yields are not so good, as particularly compared to commercial property. And so that's why we want to get to that balanced portfolio so we can get an income for life. So today we're going to unpack how commercial property can play a crucial role in building a balanced portfolio, and how it can give you that income for life blended with residential. That means you can go caravanning, you can go overseas holidays, and we'll talk about some of that. To help me unpack how commercial property can play a valuable role in your property portfolio, I'm delighted to be joined by Brad Dunn, Key Relationships Manager at Westbridge Funds Management. Brad's been here 7 years, and I can imagine he's spoken to thousands and thousands and more thousands of clients. Brad, great to have you with us. Look forward to chatting today.
Thank you, Damien. Appreciate it. And yeah, you're right. I've spoken to way too many investors. I actually think a lot will be listening to this sort of stuff, so they're probably sick of my voice by now.
Well, no doubt they'll give you a critique, as they often do. So expect some emails, Brad.
Oh, mate, once they're finished going on their trips around Europe and travelling their caravans around Australia, they will definitely let me have it. Don't worry. And
that's an interesting point, and we'll cover that today, about how the beauty of, if you've got a great investment portfolio, particularly if it's managed well by somebody else. Lots of our clients do lots of travelling, and we hear the stories, so we might get into some of those. No names, of course, Brad. Why do you think our clients like commercial property? And putting aside the funds, we'll come to that, but why do you think they like commercial property over residential property?
I think that's a good point. I think there's a number of different reasons there. I think when you first start to speak to these investors, quite often they're not even aware about commercial property. You speak about a property investment and you think straight away residential, and that's it, right? They're thinking, that's all they've got to it. I can just keep buying residential properties, and quite often they've got a decent portfolio of residential already, and they're just not aware of what else is out there.
Do you think that might be because they think it's out of their price point? Maybe because we know some of these commercial properties can go from 5 million to 500 million. Do you think maybe that's one of the reasons?
Oh, 100%. I mean, it's just not even on their radar, because they just see this big warehouse or this shopping centre and they think, well, that's what the big guys buy, not me. They don't realise that they can actually be a part of it. And once you educate them and get to show them how these things work and the better income you can get out of it over residential, it really changes their mindset.
And so when you're talking to them, and depending on the time of the market and how interest rates are, et cetera, you can certainly the yields are a lot better, aren't they, on commercial property compared to residential?
Oh, 100%. So where you probably, I mean, you're the expert on this side of it, but where you're yielding maybe 4 to 5% sort of yields in residential, commercial, you're talking your 6 to 7s, and they get that growth over time. And that beauty of them is the leases and everything that's attached to it. So
yeah, and that's an interesting point. And in terms of residential, 4 to 5 is often the gross yield. By the time you take out your expenses, it often's 3.5%. In some capital cities, it's around 2%. So one of the reasons why, certainly in the book, and why I'm very much a strong advocate for commercial property, is that all of us are investing for a goal. Most of us for retirement income stream, but it could be other things as well. But any which way you look at it, if you're going to live off that income stream, 2% to me just doesn't cut it, and that's the beauty of commercial property. The fact that you can get those 6s and 7%, and I guess one of the things that's important, and why some of our investors like commercial property, particularly through the funds, is that ability to diversify. Do you want to tell us about how they can diversify through commercial property funds?
So I guess the beauty of it is, you touched on earlier, is most people think it's outside their price range. And, well, it probably is. If you're looking at a core, any sort of commercial property, and, you know, you don't want to be buying something sub $1 million in a weak location with a weak tenant, mum and dad sort of deli, which, you know, could do well for some years for you. And, yeah, you'll get some good yields off it. But if it's vacant, God, you're vacant for years. It's not like a residential property where you just get another person in. They don't understand that. But when you realise that in our funds and in these sort of commercial setups, you can be buying hundreds of millions of dollars worth of good quality core industrial, commercial, retail, healthcare, you name it, big buildings with big quality tenants like as big as Bunnings and Wesfarmers and all that sort of stuff. And they're locked in for 10-year sort of leases. So you're getting an attractive property, but you only have to put, you know, upwards of $50,000 a time in these funds. You don't have to put the big dollars in, so you can spread and diversify across all different strategies.
And you mentioned a point there, Brad, and that brings up repressed memories in my head, which I'm not scarred by. Again, all these mistakes I keep coming up in these podcasts. But this one, I'm exactly that person, Brad. I had an office that we started when we started the Momentum Wealth business some 16 years ago. We left there, we moved office, and I had developed and kept the office. And at one stage there, it sat vacant for over 2 years. And now, luckily, it was my only investment property, but that still scarred me. And I guess that's the beauty of investing. If that was one person's only investment, going 2 years without income, that would have been pretty diabolical. Luckily, I did have some other investments. But I guess that's the beauty of funds. Even if you're investing in a fund in a single asset, you can still spread. Rather than putting, for example, $500,000 into one fund, you could put potentially $100,000 into 5 different funds, couldn't you?
I mean, if you look at our average investor and what they invest across our sort of our own funds, let alone going across multiple different companies, you know, they're averaging 4 to 5 plus investments. We've got guys that have put in 40 different investments with us. They just spread the risk, right?
And that's important. And look, maybe we just take a step back and maybe explain. I'm hoping everyone's read the book, but some may not have. So for those who haven't read the book and listened to this podcast,
Amazon, pretty cheap, yeah.
No, it's is it? I don't know. It's going pretty well last time I checked on Amazon. So, Brad, can you explain how funds work, just so that we can give the listeners an idea about that? So, if, for example, I was investing in a fund that had maybe a $20 million asset, single asset fund, the fund would raise maybe around $10 million, and then they'd borrow the balance from the bank. And if I tipped in $100,000 of that $10 million capital, how does that work? How do I get my returns from that fund?
Let's bring it back to the beginning though. Let's assume that people have no idea about how these funds work. So the way I'd explain it is you've got basically a unit trust set up. So there's a unit trust where investors can go into that unit trust. The unit trust owns that property. So that $20 million property you're talking about, we're buying it into that unit trust. So anybody who's putting that money in, so say it's that $100,000 or $1,000, they've got 100,000 units in a fund that has 10 million units in there. So you have got a tiny percentage of the thing. That's fine. I like to drive past the funds I'm in and say to my kids, hey, look, we own 3 bricks in that one there. It's fantastic. And all the Dan Murphys we own, I'm there frequently because I like to be a really good operator there.
You keep our rents high on those, Brad. Well done, you.
I do, thank you. But yeah, going back to the fund, so you got unit trust structure, you got the assets sitting in there. We always take a portion of debt because if you've got 20 million investors and $20 million asset, that's a lot more investors, which means less to be able to divide out. So that's the reason why we take on some portion of debt, reasonable level, but you go in. So say you got your 10 mil worth of investors, they go into the fund, they are essentially a part owner of that asset. Now, the management company looks after the running day to day. They look after the management of it, the strategy. They make sure the tenant's paying the rent. They do absolutely everything. All you need to do is put your money in, and every month you'll be getting a nice distribution that comes out.
Yeah.
Now, these distributions, they're quite handy for people, especially when they're looking for income, because it's pre-tax. So you're actually getting 100 cents in the dollar getting paid out. You're not going to escape tax. Government's never going to miss you. But what you will be doing is getting it into your bank account so you can actually do something with it, whether it's go on that caravan trip or reinvest or do whatever you want.
Yeah.
So from there, you've got your investment in there, you're getting a monthly income, you're getting what's called a tax-deferred benefit quite frequently as well. So, obviously you need taxation advice around where all that works, but at the end of the year, you just hand in a one-pager to your accountant and go, here you go, 30-odd% of it or whatever it ends up being is tax deductible back off of that. So you go there, and of course, as the time goes on, the increase in the leases and the in performance of the property, that distribution each month can go up. Hopefully, obviously, depending on interest rates and all sorts.
Yeah.
And then finally, as you look to sell down the asset or do something with that asset, then you're also, getting an advantage in proportion of what you put in the money with the capital growth.
Yeah.
So you're getting a triple advantage.
So, yeah, exactly. I mean, so if you're $100,000 in a $10 million fund, that means you own 1%. So you get 1% of the income and you get 1% of the capital gain. Tell us about the diversification and how the clients perceive that and why they like that investing through funds. Tell me about how they feel about that.
Yeah, they love it. I mean, the beauty of these things is we got a very simple example of just one asset going in, but every fund can have a different strategy. You might have a fund that has 8 to 10 big quality commercial properties all around Australia in core locations with big ASX listed companies as tenants, and that grows over time. So you're spreading your risk within that one fund. So an investor might say, hey, look, I really like that one. I'm going to invest multiple times into that one fund because it's got the diversity all in itself. Or you might have a strategy where it's a bit shorter time frame, a bit more aggressive, a bit more risk for return. So your income might be higher, or the capital growth might be higher, or you might be doing a value add to it. So many different strategies out there. You just tailor what you want in the fund and you put your money across them. And of course, the big thing is you can put small amounts across a whole heap. I mean, I personally think I've counted at last count, I'm in about 30 different properties. It's fantastic.
A couple of things that I just want to cover off, Brad, on some of the advantages of commercial property that some of the listeners may not be aware of. So we know that, and you've got residential investments like I do, and they are good investments when you're starting out, but there's always that pain when you get the bill and you get your rental statement and all the repairs and maintenance you've got to wear out of your pocket. And the rents go up and down. The rents are only fixed for 6 to 12 months and the market's going up. That's great, but it also can go the other way, as no doubt you've seen and I've seen over the journey. But tell me about commercial property, how most of the leases are written, and in terms of the rents. Let's start out with the rent reviews, and then we'll come back to who pays outgoings. But let's start with the rent reviews. What do you see, and what do the clients like, particularly about the way the leases are mostly written?
Residential property, you've probably got a 6 to 12 month lease in place, and the government's designed it basically to look after the tenant. But you get a commercial property, the lease is designed to however we've built that lease, and quite often they're paying for all the outgoings, they're paying for the land tax, they're paying for absolutely everything. They're looking after the property because it's their workplace, right? So I guess the rent reviews then, they can actually be built in. So you're talking about a much longer lease. So it might be 7 or even 10-year leases in some cases with these tenancies because they want it there. That's their business. They don't want to lose that tenancy. And built into that tenancy can be fixed increases anywhere from 1% to 3% to CPI, which has been wonderful for what's going on with inflation. So it really does protect you against those inflationary environments.
I think that's a critical point. As long as the tenant, of course, that's the number one critical thing, make sure the tenant's viable and going to stay there. And a lot of the ones that we buy are global companies or subsidiaries of global and national companies. But the rent reviews are often, they're either CPI or they can be fixed amounts, 3 to 4%. And particularly if you've got a 5 to 10 year lease, that's good income certainty that you're not going to have vacancies as long as the tenant's still viable, and you're going to have that consistent growth. You know exactly what you're getting. I think the other important thing too, that why I like commercial property is the fact that the tenant pays the outgoings, and you mentioned that there, that the rates, the taxes, the land tax, the property management fees in a lot of cases. Now, it's a little bit different with retail. I won't go into all the intricacies. There are some Retail Tenancies Act that make it slightly different, but by and large, it's a much more consistent income stream, isn't it?
Oh, 100%. And that's your peace of mind. And that's what a lot of investors just absolutely love. They look at the tenant and they just go, yep, I know that these guys can afford to pay the rent every single month, and I'm going to get my distribution.
Certainly, that's one of the reasons why I know our clients get to go on their caravan holidays with no worries, because all the stress is with our team to make sure those tenants are still doing what they're meant to do, and making sure when the leases come up for renewal, that's a big part of the negotiations. But certainly, no, we've done very well at getting those leases renewed. Now, tell me about, when do you find most of the clients that you deal with start to think about a transition into commercial? What sort of age brackets are they typically, and what's driving that decision to go into not only commercial property but commercial property funds?
So I guess there's 2 points there. There's the time when they should be getting in, and the time when I'm actually convincing them and getting them to understand to go in. Some of my wealthiest, smartest investors, they started in their 30s, right? Like, I guess the answer to there is once you've built up a core residential portfolio, right? So you always start with residential. Someone smart bloke who wrote a book actually talks a fair bit about it, so we won't go there. But look, once you've built up your wealth through that gearing, through that residential property, and you got that capital gain, and you're starting to think, I don't want to be working until I'm 90. I don't want to work until I'm 70. I want to retire early, so I'm starting to look at income, and income's just not going to cut it with residential. That's when they decide. So I guess if you look at it and you look at some of the performance of, well, just our funds over the past 10 years, you know, they take time to grow, but compounding's so powerful. So if you're starting in your, you know, early 40s, for example, and in 10 years' time you've got a great portfolio under you and you're building that great income, it's just fantastic. So I hope that answers it. Most people I do see aren't coming to me until their mid-40s to 50s, and that's when they're coming to me going, sugar, I wish I'd started 10 years earlier.
Yeah. Look, it's never too late, and that hopefully still gives them an opportunity to diversify that portfolio. And as you know from the book, my philosophy is a balance of both, that you're not all commercial, you're not all residential. That 50-50 blend of investment still gives you decent capital growth, and residential is generally lower risk on its own, but of course you can get your risk lower with commercial by that diversification that we've already spoken about. Now, of course, we love funds investments and we love the great opportunities, as do our clients, but there's a couple of things they do need to know about that, and that is nothing's perfect. So talk about liquidity. So if you go into a closed-end fund, for example, that's got a 7-year term, what does that mean in terms of my investment horizon?
That is one of the biggest issues that I do find is their understanding of liquidity. These things are not short. It's property, don't forget. You can't just buy and expect to make a big jump overnight. So you need to understand that once you go into these funds, you don't have the option just to get out whenever you want. It's not like a share where you can just buy and trade on the market. You know, once you're in, you get that security of having that lease. You get that security of getting those distributions in exchange for not being able to get out until it's completed. Now, a lot of my investors, they actually love the fact that there's not a lot of liquidity in it. It's actually a less of an issue once they start to get their head around it, and it just gets people thinking and planning out further. You know, when you're heading into retirement, you're looking at all your different investments and you're going, when does this one roll off? Because I want to be able to put some money back in at the next point and the next point and the next point and roll it and just compound it so it grows and grows and grows. So that liquidity isn't necessarily a bad thing, but you do need to understand that if it's a 7-year fund, you're not getting your money out until 7 years. And sometimes these things can actually, if they're performing strongly, be voted to extend even further. Some of the strategies are you get out at 7 years. Others might be that it could continue on for up to 12 years.
Yeah, and that's an important thing for people to realise. A little bit less control from the liquid, because you can't just make the decision to sell. You're bound by the fund term, the constitution, and the information or memorandum or product disclosure statement.
Control's very big, yeah. So if you want to manage this property yourself and look at the lease and run through it all with a fine-tooth comb, guess what? Go buy a direct commercial property, because that's not for you. If you would rather be travelling around the world, enjoying life, looking after grandkids, playing golf, and just getting a regular monthly income managed by experts and let them run with it, then that's where you should be looking.
Yeah, and look, if you've got it, that's why I guess it comes down to the due diligence on the fund manager, doesn't it? You've got to make sure, because that team is controlling the property, making all the decisions. That's why it's so critical to be asking them, well, what's your track record in commercial? What's your vacancy rate? How have you historically gone? And look, over the long run, there's always going to be ups and downs in the commercial property market, as we know. But you want to have a look at that manager, don't you, to make sure that they've got a great team and a decent track record.
It's one of the very first questions I get every single time. Who's that bloke with the weird head on the book there? I need to know a bit more about him and his background before I'm even going to consider it.
Well, they must be talking about you, but I didn't hear on my book cover there, Brad. But look, one of the other questions is they talk about retail investors, and that doesn't mean retail shopping centre investors. That's a Corporations Act definition. So just tell us about wholesale versus retail investors, and what does that mean if it's a wholesale only fund?
Yeah, so there's two types of licenses that a property funds or quite any sort of investment fund can hold. It's either a retail or a wholesale license, or in our case, both. The retail license basically is anybody can get in. Anybody who has the required amount of money and understands the risks, they can get in regardless. So that retail license does come with a lot of protection from ASIC and all sorts of stuff, but what it does also mean is you're going to be reading a very long lot of information because we have to make sure absolutely everything's covered. If you've got a wholesale license, it's something that's governed by, I'm pretty sure, ASIC, and they're basically saying to you that if you can be covered off and get an accountant to sign off to say you are a wholesale investor, you can go into these wholesale funds. Now, generally, wholesale funds might carry a bit more risk. Definition of a wholesale license, or wholesale investor, I should say, is one of three things, and it doesn't have to be all three. It can be one or the other. The first one is if you've earned, on average, over $250,000 over 2 years, and you can prove that and the accountant's happy to sign off on that, then you get a wholesale investor certificate. And the second one is if you have net assets of $2.5 million. Now, a lot of people don't realise they get across that line pretty quick these days. If you've got a house in Dalkeith or something, or even in Applecross these days, you're 3/4 of the way there. Finally, the third one, if you can put $500,000 in any single fund, you don't need a wholesale licence and wholesale certificate. Now, if you got $500,000, of course you're a wholesale investor. So hopefully that covers off on it. It doesn't mean that a fund, whether it's retail or wholesale, is any better or worse. It's just going to basically explain that, it's what you are governed and controlled by. Wholesale gives you a bit more flexibility to look at more funds, that's all.
Yeah, and often the funds with a bit more risk, a lot of the fund managers run them as wholesale. Like every fund carries risk. There's no such thing as risk-free in property. If you want risk-free, go into government bonds. It's about as close as you'll get. Now, all situations are different, and look, we don't give personal advice. We talk about the property and the funds, but we don't give personal advice to people. So what are some of the factors to consider when assessing whether a fund or commercial property is the right fit? And maybe you can talk about that in the context of how that applied to your own commercial property journey.
Yeah, definitely. Now, I guess happy to talk about my own journey and how it goes. Just bear in mind, I hope my wife's not listening to this then.
We won't advertise it, Brad. We won't tell her.
Fantastic. All right. So I guess for myself, I split it across several different areas. So there's one part, since our kids were born, we'd been putting aside a little bit of money each week just to build for their future portfolio so they can afford a house in the future or a car or, an education, whatever it ends up being. So knowing that we had that investment timeline there and we wanted to protect that money, that's the reason why I went into those diversified funds, which have just long-term growth, nice solid tenants in there, and it can just compound, and they've been doing absolutely amazingly, so much better than if you just left it in the bank. And I know so many people do that, so just have a real think on that side. But then there's the other side of it. It's my wife really wants to retire, and I said, right, we have to look at a bit more aggression. Then we're going to have to look at some of these value add commercial opportunities, because if you want to work less, so let's go from 5 days down to 4, let's look at getting a blend of income and capital growth coming through. And so we've been focused on any of those value-add sort of opportunities, the industrial funds, those sort of ones that we've been doing. The total return funds are fantastic. We've been going into them. So quite happy to say she's gone from 5 down to 4 days, and she's edging me every single week about trying to get down to 3. And I'm arguing, well, you know what? When do I get to go down to 4? And I'm sure you don't want that, Damian.
No, that's not happening, Brad. I'm putting you to 6, actually, from starting next year. So, but I guess that's... knowing your goals, so you've got goals, and that's important, and you're still relatively young, both of you, in your 40s, and understanding, I guess, your risk profile. You've obviously been in the in the business for a long time and you understand that some of those funds carry more risk, but you're willing to take a little bit more risk in some of those funds to get to those goals, aren't you?
Oh, 100%. Because we've got the wage and the cash flow coming through, we can afford to take that little bit of extra risk, and it's not unnecessary. It's not huge risk, but it's enough that we're comfortable with and understand it. And, well, it helps that I can tap the guys on the shoulder next to me who are actually running the show if there's anything goes wrong. So it's all good.
Brad, I just want to talk about some case studies and of some clients and when they've added commercial property to their portfolio. So let's talk about the first person. I'll mention their first name only because there'll be a lot of people with this name, so we won't. Neil. So tell us about Neil and how his journey to get into commercial property.
Oh, Neil. I like Neil. He's fantastic. So Neil's got a great story, which is the reason why I did mention Neil to you. He was on a wage and he'd built up some residential property when he was younger, and he's just been sitting on it. It wasn't a great wage. You know, he does okay and ticking along. But one thing he was very smart in doing is once he'd gotten his residential under his belt, he starts to look at, you know, I've got a plan that I want to put in place. Now, let's just say he's got a role which is very detail-orientated in insurance adjusting. So you can imagine the level of cash flow detail this man has. He's fantastic. I love him for it. Every single time he had $50,000, he would go into one of those big multi-asset commercial funds, long tenancies, just sit on it and compound and compound and compound. So every time he got $50,000, and quite often we'd let him in even less because he was just so keen to get into the next one and the next one, that over the next 7 or 8 years, he's invested 15 odd times. But he had this one goal, and every single time he'd ring me up and he'd check and he'd go, what's my portfolio looking like? How much have I got? Because once I've got $1 million in funds, I'm going to have enough income to retire. So the day that I hit $1 million in funds, I'm done. I'm out. See you later. Off to see the big wide world. Can't wait. Anyway, 5 years in, and he's still going at 50K a pop, and it's going to take a while to get to $1 million. The poor guy. I felt for him, but he was really compounding and building. It was fantastic, and it just shows what the power of compounding does. So he got to the point where he's like, you know what, these residential properties, the market's jumped. I'm not getting a great income off them. I'm going to sell them and put some lump sums in to get me closer to retiring quicker. Best decision he ever did. He sold, made a great bit of money. All of a sudden jumped, and I can very proudly say that about 3 months ago, he clicked over his $1 million because he's had these funds for a period of time. I think he's averaging, 10% in distributions at the moment across them all. And so he's now making $100,000 a year, doesn't need to work, doesn't have to rely on the government or the pension. He's literally over the moon, about to retire. That's such a great story for just someone sitting on a wage who just started early enough and just kept that focus.
And it's like, we always say in residential, we would love to time the market, but time in the market's more important than timing the market. And I think that's the same in a lot of respects for commercial, is the sooner you start, the better, isn't it?
100%.
Yeah.
Yep.
Now let's talk about another couple, and I won't mention their names, but you know who they are, and they've built up a portfolio. They started in residential, and tell me about their journey now to get into commercial property.
Yeah, I like this story as well. These guys were a little bit different. One had a business which was really taking off. The other worked in mining administration. So they had a good blend, a bit more power behind them to go a bit harder and quicker. We helped them to buy through our buyers agency on the property management side, on Momentum Wealth side, and helped them to buy some really good assets which grew quite quickly. But what they found was they wanted to retire, and you can't do that with just capital land value, right? You need to actually get your income. So they started to look on the other side and started to go into the commercial funds. And their strategy was a lot more, how can we get in and out quicker? Don't just want the income. I want something with a bit more oomph, a bit more value add to it. I like getting some cash back quicker so I can just roll and play again, basically. And that's something that a lot of investors love to see. So they went into a lot of the more value add funds, shorter terms, but higher overall returns, where you might get, say for example, 5 or 6% on the income side, but then you're getting 5 or 6% to top up on the capital growth. And if you average that over 3 or 4 years, it's actually doing really well. And so basically all they did was just kept rolling and rolling and rolling to the point where they're at the point where there's so much money coming in that they can just keep going and going, and that's just the power of compounding. It's fantastic, and they're probably not even 50. I think they're quite early, quite young, and they're off on a really good rocket now.
Yeah, absolutely, and they're setting themselves up for life, which is fantastic. Now, Brad, as a final point, I wanted to know, what would you have liked to known that you would before you made your first commercial property investment? What stands out to you?
What would I have liked to have known? All right. You know what? I guess I've learnt so much from all the investors over the past 7 odd years, and you're right, I've spoken to absolutely thousands of them. They've all got similarities. They've all seemed to have the same sort of lessons that they've learnt and things that I learned from them that I've imparted. So it's not technically from myself, but something that I see all the great investors do, and that's that they make a decision, they ask all the right questions, they run through things in detail. They've got no issues with picking up the phone and asking or walking in and proving track records and looking at the people behind the scenes, but then they act. And that to me is the really big key. You can see straight away. I speak to investors that and ask a heap of questions, and then 2 weeks later it's still sitting on the kitchen bench, and then 2 weeks later, they missed out. They're the ones that tell me a million stories of what if. I could have gotten in on the ground at this, but I didn't. And I didn't. And you know what? They end up being 60, they still haven't invested, and they didn't get anywhere. The true investors are the ones that ask the right questions, but then make a very quick decision once they're comfortable with it. They, as they say, you don't fire with a cannonball, you shoot a bullet first, right? So they won't throw a huge amount in to start with, but they get comfortable with an investment. They put a small amount in, they understand, and then they throw larger amounts in, on and on and on. But they make that decision and they move quickly. They're the ones that I see the application forms come in the day that it comes out.
Yeah.
And they're the truly wealthy ones because they don't sit and think, they just do it. So people that come to me and give me a million stories of what if, I'll hit them up. I'm like, what are you doing?
Yeah.
You're going to be 60 before you invest and it'll be too late. So there's a quote that a lot of my investors live and breathe by, which is that Einstein said, compounding is the most powerful force in the world. Well, I love that quote, but you know what? Even compounding needs time, right? So start earlier and you'll be much better for it.
Yeah. And I think that's important. And I've mentioned before that I've seen far more money lost by doing nothing than by someone doing something. Maybe it wasn't the perfect investment decision and it didn't go exactly to plan, but I've seen far more money lost by doing nothing. And you're never going to get rich sitting on the sidelines. And you've got to do your homework and look around, but certainly making a decision when the time is right. Thanks again, Brad, for joining us. Great to have you here today. And thank you to our listeners for joining us on another episode of Property Investing Roadmap Podcast. Now, my parting bit of advice for you today is a simple one, and that's to make sure you stay educated on all the different options in the market. Commercial property is a $1 trillion+ asset class in Australia. Globally, it's tens of trillions of dollars. And not only that, though, within commercial, there are different asset sectors that do better than others over the time. So you've just got to have some reasonable idea. You don't have to, you hand it over to the experts, but certainly keep abreast of what's happening in the market. But there's a lot more opportunities out there in the world than just residential, and most of the daily press and all the general daily newspapers across the country focuses on residential property. Great place to start, but as you get towards that retirement and age, and when you want to start thinking about retirement, you've really got to consider commercial property. And the beauty of managed funds is that you can diversify your assets much more easily. You can go across multiple funds, and some funds have multiple assets. It won't eliminate your risk, but at least it'll help minimize your risk and allow you to do the things in life that you want to, and that's what many of our clients do. So on another note, we've got a special resource we're going to leave in today's show notes for you, and that's Introduction to Commercial Property Guidebook. It's a guidebook designed to give you some great starting insights into the different types of commercial property, how it might fit into your property journey, and the role that managed funds can play in helping you diversify your property asset base. So thanks again for joining us, and look forward to speaking with you again. Thanks for tuning in. If you're enjoying the podcast, please take a moment to rate us to help others discover the show. Please note the information shared on Property Investing Roadmap is general in nature and doesn't take into account your individual circumstances. The information is for educational purposes only and should not be relied upon for investment or financial decisions. Always seek professional advice before deciding whether to invest. Always read the PDS, TMD, or information memorandum when considering financial products. Past performance is not a reliable indicator of future performance. Today's guests are representatives of Westbridge Funds Proprietary Limited, AFSL 533936, and Westbridge Property Securities Limited, AFSL 238386. Please refer to the terms and conditions at westbridgefunds.com.au.